So we were, as one does, chatting while Julie and Mark were bringing us up to speed on the latest developments in Washington and also in financial markets. But we were expressing some, I think you gentlemen, less so me, were expressing some surprise at how long it's taken for financial markets to become sensitive, if you will, to developments in the White House. Why? Why do you think it's taken so long?
Well, I mean, everybody wants to sing Kumbaya, and they want to hear the melody keep floating through. And that happens all the time. And you said it was, why did it take so long for the stock market to react to the White House? But it's much more than the White House.
Yes.
It's North Korea. It's Chinese islands in the South China Sea. It's Venezuela. It's the Ukraine. I mean, it's the Middle East. There are all these headwinds. And the New York Stock Exchange and Standard & Poor's just pretends as though they don't exist.
Mark, when I spoke earlier today on stage here at the SALT conference with the former Fed Chairman Ben Bernanke, he said investors have a tendency to be blasé about these kinds of things until it's, quote unquote, too late. Is it too late?
No, I actually think he's right. I mean, if you take a look at it and think of what Sam just said, the VIX is at an all-time low, right? So everybody believes there's no risk in the system. So Sam mentions, North Korea. All right, why don't we do one simple thing? What do you think the risk-free rate should be to invest in South Korea? Because they're right there, right? So if there's any problem, it's going to be the first country that has an issue. So what would you pay? If you take a look at where treasuries are, I think the risk-free rate, I think you're getting paid an extra 25 bips to end up buying South Korean debt. So do you think that's enough? Right? Would you say?
I take it you don't think that's quite enough.
No, I'm just saying it's like there's a lot of stuff going on.
What he's really saying is it's not quantifiable. In other words, you can't sit there and say, do we have enough knowledge to be able to quantify that risk? Do we know enough about the decision-making process in North Korea? Do we, we operate on the thesis that, they don't care about their people? Do the people not care about themselves? Do they use an anti-aircraft gun to assassinate an uncle? I mean, this is all crazy stuff. But we don't know what the facts are, so how can we make an accurate assessment?
So how do you behave as investors?
I think you try to stay away from things that don't make sense. Like, if I don't understand something, I'm not going to go invest in it because other people are saying it's fine. I want to invest in things that I understand. And if I don't think I'm getting paid enough for that risk, then I'm going to stay away.
You agree?
Yeah, I mean, in our office, probably the most frequent question asked is, are we getting paid for the risk? We're in the business of taking risk.
You need to get paid for it.
You just need to get paid for it, and you need to get paid adequately for it.
So what doesn't make sense? Where are you not getting paid adequately for the risk that you would be taking beyond South Korean sovereign debt, for example? What? And it's another way of saying what's overpriced.
Well, I don't know. I mean, Amazon trades at 125 times earnings. If you do the math, I think in 5 or 7 years, in order to justify that pricing, Amazon has to be 25 or 30% of the entire U.S. economy. The last time that calculation applied was a company called Cisco in 1997. Why is it any different?
So this is a good segue into retail, a subject I know you both care deeply about. What's a better short, Amazon or retailers?
If Amazon were a rationally priced stock, as opposed to a cult, I would imagine Amazon, which has not faltered, as opposed to all the other retailers that have.
But if Amazon, in your view, is overpriced today, and we know that traditional retail is collapsing.
But it's priced to collapse.
Traditional retail.
Yes, it's priced to collapse. So the only question you're asking is it discounted enough?
Correct.
To justify
Where's your money
investment?
safer? Is it safer with traditional traditional retail at current prices, or if you like, current spreads in the bond market, or is it safer with Amazon?
But the answer is each situation has a different answer. For somebody like me, who doesn't understand any company trading at 125 times earnings, it's not a hard decision.
Yeah, I would agree with Sam. The problem is, I think in our core business, there's a lot of, we don't invest in companies unless we can buy them somewhere between a 3 to 6 multiple. Right? So anything that's trading at sort of 10 times, 20 times, 30 times, you sort of look at that and go, okay, that doesn't make sense.
No, of course.
But I'm not
suggesting that you buy Amazon.
But that's not my world. That's not my world. So I'm going to focus on where I'm getting paid enough for that risk.
You got to remember, you're talking to two value characters, different kinds of approaches.
Cheap value.
Do either of you see value in traditional American retail right now?
Generally speaking, no. Again, tell me what the impact of the internet, tell me what the impact of, a friend of my wife was telling us the other day that she belongs to something on the internet. They send her 8 dresses a month. She picks the ones she wants, sends back the rest without any cost. How does a store compete with that?
I think it's very hard when we look at it, and we talked a little bit about it today. If you sort of look at what's going on in our panel, if you look at what's going on today, the equities of these companies have actually gotten hurt quite a bit. But they're only
more
levered,
than the bonds.
Well, far more, because they're levered 2 to 3 times. The ones that are levered more than that, so J. Crew,
for example, Route 21.
Yeah, any of those are having real issues because those bonds are trading around 40 or 50 because you're going to be in a restructuring. So the problem or the opportunity for us today is figure out, all right, which of these companies are going to survive and what's their cost structure?
And of equal importance, at what point do you want to play? I mean, this is, in a way, what we're describing is a falling knife. And the question is, do you wait till it bounces off the ground and then catch it on the rebound? Or do you try and catch it while it's still falling under the assumption that you know how far the ground is?
What I would do, especially with retail, I want to see it bounce. I don't want to catch it. You want to see where it's going, because the one thing that you don't know is a little bit of what Sam said. You and I, or Sam and I, used to go to the stores to go shop, right? My kids have zero interest. Everything is bought off the internet. And I don't know, where is that tipping point, right? And I don't know where that tipping point is.
Is there even a bounce, right? Or do J. Crew and Route 21 and, I don't know, Neiman Marcus, and I could name Sears, I could name a whole host of retailers. Is there a bounce for traditional retail, or did they go the way of Blockbuster?
Well, I think one of the real issues that everybody is looking at today and trying to quantify is, are we at the inflection point where 12, 14% of retail is now on the internet? Is it about to go to 25?
What do you think?
Or I'm afraid it is. And as a real estate guy, I look at these companies, already maybe 50, 60% of the space in America is obsolete. And the truth of the matter is there aren't enough churches to fill the big empty boxes.
Speaking of inflection points, people thought that $50 was an inflection point for oil. Oil is proving to be a much more challenging industry to figure out than that. You've both been active in energy. With oil where it is today, roughly speaking, $49, $50, what interests you?
Well, I think that, at least for us, we're still bargain hunters. We're still looking for situations that are less dependent on the problems of oil and more dependent on the problems of the producer. So I think that there's a lot more opportunity today in, frankly, grave dancing over leveraged players than betting that the price of oil is going to 60 or 40.
I would say the other issue, and why we're sort of investing quite a bit in that sector right now, is what you're seeing is the cost of extraction has actually gone down dramatically, and that technology
continues to decline.
Continues to go down. So whereas in the Permian or in the stack where you had to have oil at 50 to end up breaking even, now that cost is probably 40 or it's going down. So really what the opportunity is today, it's not trying to make a commodity bet. Really what you're trying to do,
as Sam says.
Yeah, really what you're doing today is you're saying, hey, I'm going to deleverage these companies, and I now have the optionality that even if oil goes down to 30, I'm fine. I'm not making a commodity bet. What I'm doing is investing in a really good company that even if oil goes down, I'm going to do fine. But if oil stays where it is, I'm going to do exceptionally well. And to do that, what you're having happening today is this massive deleveraging that's going on. Because remember, everybody borrowed money when oil was at $100, right? So oil,
you've been able to refinance some of that debt.
Yes, but what you're doing now is you're wiping out the unsecured, the sub-debt, and you're wiping out a lot of that debt.
The junior parts of the capital stack.
And as you do that, that's how you're creating this value. So the real play in the energy sector today is on the restructuring side and playing at the top of the capital structure. Anybody who plays at the bottom, they're making commodity bet, right? Because they're saying
that's implicit.
They have to, because that's the only way they're going to get paid.
Sure.
So, where do you're looking for opportunities, over-levered companies? Where?
Well,
in shale country, principally, or
in shale country. We bought a couple of refineries this year. Assets and that are energy related. I think are mispriced. I mean, and when I was focused on real estate, the issue was replacement cost. When we're buying a refinery at 10 cents on the dollar, which is what's going on, or something like that, that creates a lot of optionality.
And you, Mark?
We're investing in a couple of companies on the drilling, on a sort of packed Pacific drilling.
Side.
Yeah, on the service side. Part of that is, for these rigs, they ended up costing about $750 million when they were first built. If you look at companies today that are not levered, that are in that same industry, those rigs are going for around $450 to $500. So, you've had a third of the value has gone away because of what's happened with oil prices. We're able to buy into companies that are being restructuring today. You're creating those same rigs around $200, $250 million. So you're creating them at a 50% discount. And the reason for that is you've got to do this huge restructuring. So I think you're getting massively overpaid right now to end up doing these restructurings.